Kłaniam się Państwu. Zapraszam na kolejne wydanie programu Prosto z Parkietu. Moim Państwa gościem jest dzisiaj Joe DiNapoli, znany trader, weteran trader, twórca z popularnych systemów tradingowych. Serdecznie zapraszam i uprzedzam, że rozmowa będzie po angielsku. Hello Joe, it's a pleasure to have you here.
Pleasure's all mine.
I have two sets of questions for you. Actually, the first part will be the questions about the trading strategy and how the markets have evolved over time, and the second will be about, let's say, the near-term prospects of financial markets. So you have been an active trader for 3 or 4 decades now, and I'm wondering how has the market changed over this time? In terms relevant to the trading strategy, trading tools?
Actually, it's probably been 5 decades, if you can believe that. It's been a long, long time. There was a very major change in markets, and it occurred in March of 2009. And this is when Skynet took over. And Skynet, of course, is the computerized portion of trading, algorithmic trading, high-frequency trading. And Silicon is in control of our markets now, and it's not a good thing. This has been the major change.
But still, I understand that there is a place on the market for an individual trader, despite that.
Definitely, there's a place for an individual trader, but this has distorted the market. There's a big distortion in the market that did not exist before. So when you ask me about how has the market changed for 200 years prior to Skynet taking over, you had one type of market. Now you have a different type of market. And for those that don't recognize the change, I think it's going to be pretty hard for them to make money. If you go back to 2008, the financial crisis, I did amazingly well. 2007, 2008. When 2009 hit, I wasn't able to make any money. It was like, what happened? And it took me a while to figure it out, and eventually I figured it out, made some adjustments in the way I approach the market, and I'm okay. But I think unless your methods are very sophisticated and high quality, you're not gonna make it.
But what is precisely the source of the problem? You probably have read the book by Michael Lewis, The Flash Boys, and where he says that the market is rigged. So what he means is that the HFT traders, they front run other investors, etc. Is this what you are referring to? That because on the other hand, many supporters of the modern market, they say that this high frequency trading, it only adds to liquidity. That should be a positive.
It's an absolute lie. Flat out 100% lie. It does not add to liquidity, it subtracts from liquidity. What people don't understand is that high-frequency trading, it's not a question of having to pay 1/10 of a cent or a 20th of a cent or a half a cent more. I gladly pay it. I don't care. You go back to the old specialist system, we always pay that little extra. That's not the issue. The issue is the inability to get a fill. And when you can't get a fill, you can't get money. Oh, you got an order in there to buy 10,000 shares of stock, you get filled with 68. It's an annoyance. Now you try to get filled on the remaining shares and you up your bid, and then the high frequency traders up their bid more. You have to know how to get around this kind of a problem. And when you talk about liquidity, this is the biggest fabrication that anybody's ever told. These I'm a tape reader. After 50 years, I can watch the tape, I can read things just from my experience. These, not necessarily the high frequency traders, but algorithmic traders, literally these programs can be turned off. You can watch them, you can actually watch them be turned off. So when things get tough, a lot of these guys just turn the key and they're gone. So when you need the liquidity the most, it's not there. When you don't need the liquidity, yes, they add to liquidity.
Okay. And you have said that this requires some adjustment to your strategies. What were the basic changes you had to make in order to adjust?
Well, when these guys front run you, You have to be very quick about canceling, replacing your orders so you can get a fill. You have to notice the order flow, and around these particular. See, I've been using the same numbers, the Napoli level, since 1985, roughly. But in 1985 and through 1992 or so, the market come right down, fill you, immediately go to your objective. It was glorious. Today, what's happening is that these algorithmic traders sense the volume that occurs around the numbers, and then they do what we call a wash and rinse, which is a quick and drive the stops out, trying to get that inventory for themselves. So they're playing all kinds of tricks all the time, and it takes a little bit of attention. Actually, takes a fair amount of attention to figure out what they're doing. When you get that figured out, you can still make money.
Well, maybe the solution is simply to be a longer-term investor. Then you don't have to worry about short-term fluctuations and being front-run.
Well, that is a logical conclusion, but it's really not true. What happens is that when you're a longer-term trader or investor, now because of lack of liquidity, you get these situations where the market crashes down, goes through support and driven by predatory algorithms, and just opens up beyond support levels. So if you're a long-term trader and you've got a position on in a good high-quality stock, all of a sudden that stock is down 15, 20, 25%.
And you're pushed out.
A lot of people get scared and they get out of this thing because they go, well, maybe there's something wrong with the company.
Okay.
So it's a problem across the board. And the issue is that the regulators are not addressing it.
Okay. Well, and what about you have mentioned one substantial change to how the market is operating, but what about the huge inflow of liquidity from central banks and the quantitative easing that took place after the crisis? Did it matter at all?
Well, sure, it's distorted the entire economic system of the world, but it's not affecting a person getting a fill. It's not affecting liquidity so much.
Okay.
So on the one hand you've got an economic distortion, on the other hand you have the internals of the market distortion.
Yeah, all clear. Do you use fundamental analysis at all, or you simply analyze charts and that's enough?
Well, primarily I analyze charts, but it's very important that you see how the market responds to a given bit of fundamental analysis. For example, we had a report out today that the Chinese market has suffered a 14% reduction in industrial profits or some such thing. This happened today. So one would expect, you're going to see the Shanghai Composite going to be down 2.5%, 3%. It's up. It's up. Okay, so now what does that tell me as a technical trader? Well, that tells me that there's underlying strength, that the support areas in the markets are holding and people are buying. Dips are being bought. And this is how I use fundamental analysis to see how markets respond to the news.
Right. In other words, to check in which point of the cycle the market currently is.
Yes, and there's one other thing that's quite important. I developed leading indicators, so we know where there's going to be support and resistance ahead of time. So if we get good or bad news, actually this is how we are enabled to get a fill, because we're driven to these levels. Mm-hmm. So in that sense, I'm using fundamental analysis to get a fill.
Okay, you have mentioned the tools that you have developed. Could you tell if these tools can they be used on every kind of a market or only on a stock market?
Well,
let's say
I've looked. Yeah, I mean, I live in Asia, so I've used the tools in Asia. And I have many clients in Asia. They're working beautiful over there, even on illiquid markets like, the Indonesian markets, Thai markets. I mean, this stuff works. And, your far more liquid markets like you have in Europe, stuff works. Okay. So, yeah, it's effective across the board.
What about other assets? Because nowadays many investors, they don't focus on stocks only and or contracts, they buy, they trade commodities, bonds. Does it work?
Absolutely.
Okay. The same tools for every kind of market.
That's correct.
And what would be your if you were to tell only one advice to a trader, a beginner in trading, what would that be? One advice.
Get some knowledge and get some information. Learn about what you're doing before you try to do it. My best client is not the new trader. My best client is somebody that's dropped 50, 40, 30, 80 grand in the markets. And they go, wow, something's wrong here. It wasn't as easy as I thought. People really, they need to invest in decent software and in decent teaching, learning items before they try to invest. I mean, you wouldn't operate on yourself.
Yeah.
I mean, without medical experience. It's the same thing. A car mechanic doesn't just start off with a pair of pliers and dive in. They need training. Well, you need training, and you need good training, not just any training. Training.
Okay. Let me now switch to the second part of our this discussion. This year, the S&P 500 is doing pretty well after the sell-off in autumn of last year. What would be your expectations for the next couple of months? Let's say a midterm.
Well, I'm glad you started with that one, and the reason why is because when you're projecting forward on a given market and you're making a prognostication about where this market's apt to go, most of the time you don't have a strong signal, and therefore the recommendation or the thought is worthless. It's not worthless, but it's not worth very much. In the case of the S&P in the American market, we had a very, very powerful and reliable signal come in right at the end of February. It's called a railroad track. And this signal indicates new highs. And if the low holds that we had several weeks ago, 27, 22, something like that, if that low holds, the current projection up is 30, 33 as a minimum. Mm-hmm. And it is like I say, it's very high quality pattern. It's a powerful, high quality pattern. So for myself, I'm making the strong assumption, and I'm betting that way, that this market's gonna see new highs. Does
the signal tell you what is the time frame when the market can reach this new high?
The quick answer is no, it doesn't. But this pattern, again, I've been trading this pattern since, actually I developed the pattern back in 1996, and I've been trading it a lot. And usually, it's on a weekly chart that this occurred. Usually, this thing happens fast. So I would imagine within a couple of months.
Okay. There is quite a wide sense on the market that this bull market has been very long, and that there is some kind of a law of gravity, which, well, for the market that would mean a mean reversion or something like that, and that because of the length of the bull market, it has to end soon. This is quite a widespread worry on the market. Do you think that the length of the bull market is any useful information?
Well, I mean, I can't disagree with that reasoning. That we're going to have reversion to the mean, that it's been going for a long time. And if you look at the February pullback in 2018, that was vicious. That was absolutely vicious. And then you look at the December pullback of 2018, that was vicious. You don't get these, it's like an earthquake, you don't get these tremors without reason. So yeah, I think we're deep in the tooth, but this railroad track pattern, I'm looking at 85, 90% probability of it occurring. So I've got, until it is negated, I'm looking at new highs.
Okay. What does this mean for other markets? Do you think that, let's say, European markets, they simply follow what is happening in the United States as it was back in the days, or they can move in different fashion, in different direction?
You mean correlation?
Yeah.
If the U.S. market makes new highs, it's going to drag other markets up with it. But how much up, I don't know. the correlation aspect of this has not been that great. I have two primary big signals. The biggest one is in the S&P in America, going to new highs. The second biggest one, and it is not as powerful as a railroad track, but it's powerful, is the Chinese market, the Shanghai market. I mean, I've got a very large position in the Shanghai market, and I expect it to do very well. Now, I don't know if it's going to go to new highs because we don't have the right formations for measurements yet, but will it bring the Singapore market, the Polish market, the DAX, et cetera? The correlations are not that high. And when I look at the charts and look at some of these markets, they don't look that good, frankly.
Okay.
So yeah, I think it'll have an effect, but I don't think it's going to be the be-all and end-all.
Thank you very much, Joe, for your visit. A ja przypominam, że naszym gościem był Joe Di Napoli, znany trader, autor systemów inwestycyjnych.